Gold revaluation is not just a theoretical exercise, it's a practical monetary tool that can resurface when real economic pressure builds, and is something the Federal Reserve's recent discussions notes subtly acknowledge. While the Fed has not explicitly endorsed gold revaluation, their exploration of alternative monetary anchors, especially amid mounting debt pressures and questions about dollar dominance, suggests the idea is not entirely off the table. In this video, we consider 6 distinct paths through which gold could be revalued in a multipolar world, ranked from the least to the most likely. Some remain speculative, others are already being quietly tested, or at least seriously considered by policymakers. First, bringing back the old school gold standard, where every dollar or euro could be exchanged for a set amount of gold. Well, this just isn't realistic today. To do that, governments would have to give up control over their monetary policies and accept strict limits on how much they can borrow, spend, or intervene financially. That simply doesn't fit with how global finance works now, or how big countries run enormous budget deficits. Central banks wouldn't be able to step in when the economy hits a rough patch, and governments couldn't respond quickly with emergency spending when they want to. No major government is willing or able to lock itself into a system that permanently ties its hands fiscally. So while the gold standard may make some sense from a theoretical perspective and has some historical weight, it just doesn't work with the way modern economies actually operate. Some people have suggested the IMF, the International Monetary Fund, could lead a global gold revaluation using its special drawing rights SDR system. The IMF has pushed for more diversity in global money and recognised China's currency as a reserve in 2016. Adding new currencies to the SDR basket is a profound decision. But here's the thing, the IMF mainly plays the role of a coordinator or advisor, not a decision maker when it comes to money policy. SDRs are basically accounting tools that don't directly influence real-world trade or investment. So even if the IMF tried to coordinate a global revaluation through its SDRs, it wouldn't have much of an impact on the actual economy. The real power to revalue gold lies with individual countries, each acting in their own interests. Currently, no global organisation has the authority or the muscle to rewrite the rules of the world reserve system. A central bank digital currency backed by gold is not really being considered by most policymakers. It's more of a backup plan that could be used if money systems actually start to break down. Situations like very high inflation, loss of trust in regular money, or being cut off from dollar-based financial networks could push governments to think about using a gold-backed digital currency. This is something that has been suggested previously by the likes of Malaysia. Such a currency could help stabilise value and rebuild public trust, but it would also limit how much governments and central banks can change the money supply or use stimulus when the economy slows down. While major central banks and countries have not adopted this idea, smaller or more isolated countries might see it as useful during times of extreme financial stress. Emerging technologies such as mBridge show that the plumbing for real-time cross-border settlement between sovereign digital currencies is already being built. In a crisis scenario, this same infrastructure could be adapted to support a gold-backed digital unit, making the shift operationally feasible without having to start from scratch. In all likelihood, this kind of currency would just come in as a reaction to problems rather than being something planned outright, and it would show a move towards tighter control over monetary policy. A formal revaluation of gold by a sovereign state remains a realistic policy option under specific conditions. Governments can unilaterally raise the official price of gold to restructure their balance sheets or restore confidence in monetary instruments. The historical precedent is, of course, clear. As we're all familiar with, in 1933, the US revalued gold from $20 to $35 per ounce, generating a substantial accounting gain to the federal government. The same logic applies today. On August 1st, 2025, a Federal Reserve discussion note openly examined the possibility of using unrealized gains on gold reserves to finance expenditures without issuing new debt or raising taxes. The note pointed to the revaluation of the United States' 261.5 million troy ounces of gold currently held at a statutory price of $42.22 per ounce. At current market prices, this would result in an asset revaluation exceeding $850 billion. The acknowledgement of this mechanism by the central bank establishes gold's revaluation as a credible and technically feasible fiscal option. This is not a theoretical construct. It is an accounting change that could be implemented without legislative overhaul. The political barriers to adopting this kind of system may still be relatively high, but it has entered serious institutional conversations clearly. The economic conditions that might force governments to consider it include hitting debt limits, facing strict budget pressures, and needing to fix weakened balance sheets. This policy tool stays dormant until triggered, but just knowing it exists and is actively being discussed changes the landscape considerably. Global gold accumulation by central banks continues at record levels. Emerging markets are reducing exposure to dollar assets and building neutral reserves. This incremental repositioning is placing upward pressure on the gold price, of course, as we've seen over the last few years. The market is revaluing gold without the need for formal declarations. As confidence in fiat systems adjusts, the relative value of gold rises in proportion to perceived systemic risk. There's no formal transition process required here. Gold resumes its monetary role through the mechanics of price discovery and banking regulations, as we've considered previously under Basel III. This is the most credible and least disruptive path to revaluation and is already underway. It reflects actual behaviour by official institutions and a broad recognition of gold's enduring function as a monetary reference point. Finally, a gold-anchored trading system could break dollar exclusivity, for there's a growing move towards using gold in international trade as the global financial system appears to become more fragmented. Countries connected to the BRICS group and others in their orbit are building new ways to settle trade with each other that do not rely on the US dollar. Instead of changing how their domestic currencies work, they are creating cross-border systems that use gold as a way to keep trade flows balanced. Gold works in this setup because it is neutral. It is not tied to any single country, and it does not carry the risk of another nation's monetary policy. But to make gold work in modern finance and to appeal to governments, it needs to be digitized. That means using technology to turn gold into digital tokens that can be tracked and regulated. This allows governments to oversee transactions, maintain control, and make the system compatible with existing financial infrastructure. In reality, it is stealth confiscation of gold. It's something we've discussed previously here, and I believe everyone needs to understand this who takes an interest in the gold market. This digital layer makes gold a lot more flexible and useful. Tokenized gold can be managed in ways that physical gold cannot. It can be restricted, accessed, or routed depending on the rules built into the system. For states that want to reduce their dependence on the dollar but still keep control, this setup appeals very much. This is not just a concept, we're already seeing signs of it through trade deals, tech partnerships, and the way institutions are being designed. Gold becomes more than just a store of value when it is part of a digital system built to support national goals like liquidity, sovereignty, and policy enforcement. Central banks are not accumulating gold for historical sentiment. They are positioning for a world in which fiat credibility is continually being stretched. Revaluation does not begin with official announcements. Instead, it begins with procedural shifts and adjustments in accounting treatment. The Federal Reserve has now acknowledged that gold reserves can be revalued to generate fiscal space. This is a fundamental shift in how gold is regarded within institutional frameworks. Indicators such as reserve repatriation, balance sheet treatment, and bilateral gold-based instruments reveal preparation underway. Simultaneously, the rise of stablecoins backed by US T-bills introduces a digital extension of the existing dollar regime. These instruments project dollar liquidity across borders while reinforcing demand for sovereign debt. Their integration could increase velocity, but introduces new points of failure, which could be profound. It's also worth noting that the US has imposed a 39% tariff on 1 kilo and 100-ounce gold bars from Switzerland. Now, this appears to disrupt a key supply route for the New York gold market. While it's presented as a trade measure, it also serves to help control capital flows. It could influence gold pricing and, of course, potentially prepare the ground for future monetary or fiscal shifts. We'll have to pay close attention to such trends as we see them unfold. The trajectory of monetary change is already visible. The question is not whether gold will be revalued, but who initiates it, through what structure it manifests, and under what level of systemic stress. It becomes unavoidable. And of course, whether gold revaluation is conducted upon repeated occasions. The outcome is unlikely to follow a single model, in my opinion. The monetary regime will be fragmented. It seems gold, tokenized reserves, and commodity-linked systems will exist in parallel in a world of monetary pluralism. The ongoing multipolar deception means a new Bretton Woods moment is seemingly unlikely. Perhaps instead, monetary realignment is likely to happen slowly, driven by necessity and apparently competing interests, rather than by a formal announcement. I have my own thoughts on this, which I'll share in an upcoming video, and of course I hope to see you there. In the meantime, thanks so much for watching. Do consider subscribing, and I'll see you next time. Bye bye.